Good morning, this is Steve O'Hare from Signal Centre. Today's date is Monday, May the 13th, 2019. We're going to run through the markets, the financial markets as we see them today, and we're going to start with the foreign exchange, FX markets, start with the dollar index, and then run through to have a look at commodities and also indices. We're going to give a broad outlook on the levels we're looking at, the formations, the indicators that is currently controlling price action, and we're going to start with, as I say, dollar index. So a dollar index on the monthly chart, we are in this bullish channel higher, but we do believe we are looking towards prices moving to the downside. We had this Elliott wave formation, and we're in a corrective move at the moment. We can also bring in some Fibonacci retracement lines that we can see, and price action continues to struggle to break above the 61.8% Fibonacci retracement of the previous down move. That comes in at 97.87. Over the last week, we've seen trade wars dominate again, and obviously this impacts the dollar, and dollar really struggling to push any higher, with the major expectation that the trade wars will have an overall damaging effect on the dollar and the trade. Let's break it down to a more short-term chart, and we can see this ending triangle that we highlighted, or ending wedge formation that we highlighted last week. Price action has broken below the supporting part of this trend line, and the measured move target is a move to 95.74. So really under pressure. We had this downward trending resistance line, which now impacts, and any rallies towards 97.80 to 98, the figure, are expected to be sold into. Let's move on to cable. Obviously bearish on the dollar index, so bullish on cable. Cable has its own political agenda to consider, and that's Brexit. And let's take a look at the monthly chart first. We can see this downward trending wedge formation, and the bullish outside month of January continues to support the market at the moment. Brexit negotiations haven't been going well, obviously, and there's still a risk to the downside. However, we do believe that any sell-offs will be bought into. Overall, we remain bullish on the on cable, looking for prices to move towards the upside eventually. Let's take a look at the shorter term chart. This bearish channel on the hourly chart, again, trying to break higher from here. We're looking to buy into dips on a short-term basis as well. Now we look at the weekly chart in dollar yen. We can see this triangle formation dominated by the bearish outside week posted at the on the 22nd of April, start the 22nd of April. This has led to 3 consecutive negative weeks, also with a gap on the chart just above here. So be aware of that gap. Any move to the upside should see a quite an aggressive push through the current resistance at 110.96. The gap itself is at 111.05, so we could see some follow through buying if we do manage to fill that gap. We think this would be limited to the top of the triangle because of the current bearish move towards the downside, looking to target the lower end of this channel and the previous swing lows around 108.50. Moving over to US crude oil, the monthly chart, we've seen the previous 4 months of positive price action since prices tested the 61.8% Fibonacci retracement of the previous up move. This candle looks very much like a shooting star, so potential negative price action to the downside. We see this 5-wave up move, and a common corrective sequence would be an AB equals CD formation, potentially targeting an additional move lower. But obviously, investors fretting currently over the global economic growth concerns brought around by this trade war going on between US and China. So plenty to think about on here. The daily chart, we've seen the bullish channel has been broken with this quite aggressive move to the downside. So again, further price action is looking to take us lower over the more short term. Over the intraday, on the intraday candle, we're still looking at a slightly positive thread. We've had the ABCD correction lower, and we're getting this triangle formation. So we are expecting this upward trending support line to support current price action, but we are aware of the overall fragility of this whole up move. Currently, on a daily basis, we're looking to buy into the dips, but again, on a more short-term basis, definitely overhead bearish pressures to consider. On the gold, the monthly chart, we remain positive over the medium to longer term. This real line in the sand for us is 13.45 up to 13.95. Prices to break above there, we would see the really extended move higher. However, the shooting star on the monthly chart in February has dominated, and we are seeing a correction lower. The real, we've got a, we're in the middle of an Ichimoku cloud, so we've got high volatility. We're seeing, obviously, China, the world's largest consumer of gold, in the midst of the trade wars with the US, so there's a lot of nervousness here. Potentially, we could see gold drift towards the $1,200 figure. That's where we expect the medium-term, longer-term buyers to return. But a lot of two-way volatility at the moment. On a shorter-term basis, we're negative. We're looking to sell into rallies. The 1292 level is providing a pivotal mark at the moment. We're looking to set shorts in front of there, looking to target a break of this short-term upward trending support, and to target a move towards 1271, 1268. Let's move on to indices now, and obviously indices majorly affected by the trade war. We've had this head and shoulders formation that we've highlighted over the past few months. Price action has retested the break of the neckline and proceeded through it. Last week we've posted a bearish engulfing candle, and also this is a hanging man candle, so both negative candles, and we expect further pressure on indices this week, and this is we can see that today's price action has broken aggressively lower again, so a break of the 11,950 area in DAX should see a continuation in its price action, and should see this continue aggressively lower in the coming weeks. Also, weekly chart just highlighting the moving average, 10-day moving, 10-week moving average we're looking at, and prices holding around there at the moment, but we are negative on indices also. Let's take a look at the S&P on a weekly chart. Again, we've had almost an evening star formation form, but this hanging man candle is a concern. Price action has broken lower again the start of this week. Momentum is stalling and looking to turn negative over the coming weeks. So the real concern would be a continuation and a close below the low of last week. That's 28.25 in S&Ps, and that would definitely put us into bear mode, looking for a further move lower. We can bring up some ideal targets here. Would be around about the 2600 to 2575 area. That's a 61.8% Fibonacci retracement. We've got the Ichimoku cloud also on the weekly chart coming in at 2640. So plenty of scope for a move to the downside without impacting the actual trend higher. So that's our roundup. I hope this has been informative, and we look forward to speaking to you again next week. Good luck with trading.